and welcome to this special discussion on Smart Beta ETFs. Today, I'm joined by Siddharth Srivastava. He's the head of ETF Products at Mirae Asset Investment Managers and our in-house expert, Dhirendra Kumar. Welcome, gentlemen.
Thank you.
Now, Siddharth, coming to you first, can you explain what are Smart Beta ETFs and how are they different from the traditional vanilla equity ETFs that we are more familiar with?
So traditional equity ETFs target very plain vanilla broad market indices like Nifty 50, S&P 500, Midcap 150, etc. Whereas Smart Beta ETFs target and tracks an index which are created based on certain factors. And these factors basically try to mimic or target a certain behavior. For example, momentum. For example, low vol. That here you are picking companies which are doing well on momentum or well on low volatility, etc. instead of based on their size. So the idea is that my portfolio should be based on certain factors, selection should be based on certain factor, weighing should be based on certain factor, and it sorts of digress from a market cap based investing to a behavior characteristic or a factor based investing.
All right, Siddharth, you mentioned factors. So what are the key factors these Smart Beta ETFs focus on?
So these factors are sorts of very well-researched factors which have been used on the active side a lot. So factors like momentum, where you are picking out companies which are doing well recently from a stock performance point of view, nothing to do with underlying fundamental. These sort of companies behave good in a bull run, right? They have high return, high risk profile. Then there is factors like low volatility and quality, where you are picking out companies which are stable from a pricing point of view, or when you're talking about quality, which have lower leverage, better profitability, better stable profitability. And here the behavior is, let's say, more risk averse. They tend to have lower drawdowns, while they may not give you a return as good as momentum is giving, but they will have a lower risk profile. And they perform better when markets are volatile and markets are sideways. Then you have factors like value, which typically is about identifying companies that are trading at lower PE, PB, etc. And they tend to perform better when there is a broad market recovery or a broad market rally. And then one of the more popular is also equal weight, where you are picking out companies in a market segment and allocating in an equal manner. So Nifty 50 is tilted towards large cap company, largish companies within the portfolio. In equal weight, all the company will have similar allocation. And these products also tend to work well when there is a broad market rally, and all of them exhibit cyclicality also.
Okay, and what is the process like when it comes to picking the right factors for a Smart Beta ETF?
See, then it becomes very technical, right? Because you have to use underlying metrics to target momentum or to target quality, right? For example, if you're making a quality based portfolio, for me, I can pick out companies based on profitability, lower leverage, and earning stability, right? That these are very well researched parameters based on which you pick out quality companies. But then within profitability, there can be a debate that whether return on equity is better or return on asset is better or some other metrics is better. So each index provider has its own set of underlying parameters based on which they define quality, based on which they define momentum, based on which they define value, etc. But if you ask me what are the generic ones, quality is based on, as I mentioned, profitability, earning stability, lower leverage. Momentum is based on recent performance, which can be 6 months and 1 year. It can be based on 1 year alpha also. Value, as we all know, lower PE, PB, and higher dividend yield. And when it comes to equality is very simple. It's just equal allocation across these stocks.
And how do you decide which factors will drive outperformance?
So see, ETFs are vehicles, right? The idea in Smart Beta is to create a momentum-based product, is to create a quality-based product, is to create a low vol-based product, is to create an equal weight product. For a risk-averse investor, low volatility may be more suitable, right? Because it is more stable than even a Nifty 50 and a Nifty 100. Its volatility is lesser. Even a quality-based product can be suitable for a risk-averse investor in these times. But for someone who is, let's say, likes to take risk, whose risk appetite is high, who has a longish investment tenure, for him even momentum and alpha can make sense even at these higher valuations if he's willing to stay invested for 5 years or 7 years, considering that India is an uptrending market in a long run. So why Smart Beta is popular is because it gives you tools to target a certain risk and return profile based on your risk profile, which Nifty 50, Midcap 150, etc. will not give, right? Because these are generic, broad-based products. So it totally depends what the investor risk profile is, and then a particular Smart Beta may be suitable to him or her. And second, it can be also used for portfolio completion. For example, I might have my investments in active funds, which are all quality-based investment style, and I might lack allocation towards momentum-based because my allocation towards quality. Then I might take an exposure in momentum or alpha-based fund because I also want to have a piece of what is doing well in the market right now. So it's both. It's risk profile and portfolio completion.
Right, now moving on to you, Dhirendra. As someone who has observed the evolution of mutual funds and ETFs, how do you see Smart Beta ETFs fitting into the broader landscape of investment options available today?
One is that, when it comes to mutual fund, we think of actively managed fund in India.
Right.
And the index fund have gained popularity for a variety of reasons. But I don't think it is as popular as it is perceived to be based on the assets. Simply because the money that has come into the index fund is substantially EPFO money. And a lot of people think that, index funds have become very big. Not to say that, index funds are also gaining popularity. Now, the Smart Beta funds are somewhere in between, bridging the gap between active and passive. And the advantage of the passive fund, the index fund, is that they give you some very structured framework. It gets you exposure to the market. The primary benefit of investing in equity is to get the market exposure. Right. There has to be a tailwind to the market. If India does well, index will benefit, so will be Smart Beta, so will be an active fund. Some of the active funds might do very extraordinarily well. Some of them who will get it wrong will do very poorly. Smart Beta will give you predictability with customization that, okay, I know this. So it is a very nice bridge between active and passive. It still has to gain traction because, investors have to, start understanding that what it is. A lot of people, everybody understands return very well because it is measurable. Rest of the thing is very cyclical. You like it when it benefits, you don't like it or you hate it when it hurts you. Like, for example, momentum. The one big advantage is that it gets you a lower cost with almost an understandable active management which you can relate to.
Right, now, Siddharth, we know that factors can be pretty cyclical. So with that in mind, how should investors think about Smart Beta ETFs, especially when considering momentum?
I think investors should be very cautious and should do obviously right amount of research before they take exposure in momentum or alpha product. Right? Because see, India is an uptrending market. We are lucky to be in a country which is doing so well in last 10, 15 years from a market performance point of view. If we remove global financial crisis, taper tantrum, COVID, you'll hardly find years when India has given negative returns, right? And that is why momentum strategies have done so well, right? And they have given very good returns, especially in last 3-4 years. They have given stupendous return, but they have higher volatility also. On events like we had in June, in August, those black swan events, it will typically correct more than the market. If market for some reason becomes very volatile or sideways, it can fall more than the market. So people should be ready to absorb that behavior also. Momentum strategy on a standalone basis cannot be your core allocation. It should either be with low volatility or a counter sorts of method-based product, style-based product, or it should be part of your satellite portfolio. So that's very important to understand. And this cyclicality is true with other smart beta products also. So to counter it, either you should have a longer investment horizon, that you are willing to stay invested for one downturn because you are looking forward for one or two up cycle also, or you should be able to sorts of stay invested and time it in a very nice manner and willing to take that higher drawdowns also. So I think that sort of awareness is needed for investment in smart beta products.
Dhirendra, given the cyclical nature of factors in smart beta strategies, what would you advise to investors?
Investors must appreciate that not only factors and strategies, markets are cyclical.
Right.
The components of the markets are cyclical. So factors are also cyclical. Now comes, how to deal with it. One is to actually reconcile that things will be cyclical. If it is market, if it is even interest rates are cyclical, you think that by investing in fixed income, you are able to insulate yourself. Yes, in a combined portfolio, you can reduce the volatility, or you can reduce the extreme volatility, or you can avoid the extremes, you can gain some stability. So set your expectation. Make sure that you are prudent about the factors you choose, because in good times, people just might get, attracted to momentum at a given point. And then that will come to haunt you in another context. So be aware of this. So try and diversify across factors as well, because just liking it in one weather, you need a well-groomed portfolio. Best thing about smart beta is that, predictability. Right. It is clearly stated what it will be. And it will not do anything else. And hopefully by doing those things, it will look smart. Hopefully, because that's the whole design. It's on the premise that index funds are not so smart. And here we are doing some tweaking, some re-engineering, some reconfiguration, so that it gets smarter than index.
Now, Siddharth, many smart beta strategies, they rely heavily on historical data. How much can we trust this data to predict future performance?
So I think that's a good question, because when we go ahead and talk about smart beta, people say that it is just backtesting. But the good thing is that at least National Stock Exchange has launched a lot of these smart beta products, especially single factor based and even multi-factor based, way back in 2016 or so. So you have a rich history of almost 8 years now, where you have 2018 crisis, ILFS crisis, you have COVID, and then you have a bull run, etc. And then, so you have seen already a cycle or cycle and a half, and see how these factors behave in live market. And then you also have smart beta products globally also. And you can see how they have behaved in different market cycles. So I think now more than enough data lies. And I'll also tell you that people, while they are chasing momentum, etc., I think there is so much of information out there available that people are now doing allocation, let's say low vol plus momentum, low vol plus alpha, trying to sorts of protect their downside if there is a correction, etc. So people are already analyzing these indices, which have been live since long, and taking actions accordingly.
All right, now finally, who do you think should consider smart beta ETFs as part of their investment strategy? And are there any better suited profiles or certain types of investors that should be investing in this?
I think that's the beauty of smart beta, that it can allow you to do so much. For example, I know a lot of counters which use alpha and low vol ETFs individually to mirror a large cap or a large and mid cap portfolio, right? Because these are very counter strategies. Then I know investors who use alpha just because they are okay taking more risk. Then I know a lot of investors who are very conscious or skeptical about markets right now because of higher valuations, but they want to remain invested in the market because there's no better place to be from an investment point of view. They invest in low volatility, right? So I think there are multiple things which you can do with Smart Beta. The better question should be to the investor that what is your investment objective? What is your risk profile? The Smart Beta product which you are choosing, is it aligned with your risk profile? Are you okay with its cyclicality? And are you investing for the right time horizon? And do you need to add one more product to counter the riskiness of this particular product? So I think Smart Beta role is to provide options. It's a buffet, right? And then you have to pick the right food based on your appetite.
Well, for the last word on this, let me go to our in-house expert. Dhirendra, what would you like to add here?
I don't have anything more to add, but I would like to just summarize it. One is that if you are investing in Smart Beta, almost everything remains the same when it comes to investor. You should be a long-term investor. You should be patient. You should be somewhat a regular investor because even Smart Beta will have the cyclicality. The reasons to like Smart Beta, I think 3-4 reasons. One is it is structured, so it is predictable. So it is, it comes with a transparency of what it will do, what it will not do. You will not get a surprise of even a fund manager. Then, it can also capitalize on some of the inefficiency in the market, because what happens is we think that the market is efficient. Not really. Many a times the large cap index or the Sensex or the Nifty or a BSE 500, you will see the weightage of underlying, because the capitalization weighting brings about bias of momentum in these indices as well. The bigger gets bigger simply because, a lot of money and index fund becoming bigger is also driving that, more, it attracts more money and that drives the market in that direction. So potential to spot an inefficiency and it will be able to capitalize simply because of discipline. So discipline, cost effectiveness and, structured mechanism. What is not changing is that you are an equity investor. When you are investing in equity, you are choosing an active fund, you are building your own portfolio, you are choosing a Smart Beta or an index fund. You have to be prepared for all those things anyway.
All right. With that, time for us to wrap up this chat. Thank you, gentlemen, for the valuable insights. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.